In this episode, we're walking through some of the most popular tax strategies on the internet with a real CPA to see what's legit, what's a lie, and what's a simple exaggeration. I'm excited to introduce Chase Insania, an expert CPA with over 20 years of experience in the tax strategy, financial planning, and entrepreneurship. Chase, welcome to the BetterWealth Show.
Thanks for having me.
Before we jump into this lovely internet TikTok advice that I cannot wait for you to share your thoughts on as being a CPA, why don't you give a little bit of backstory on who you are, how you got into this space, what you do, before we jump into you reacting to some maybe really good or some really bad internet advice when it comes to taxes.
Yeah, cool. Again, thank you for having me. Yeah, Chase and Sonia, I have been doing this about 25 years now, working with small business owners, accounting and tax mainly. Always was entrepreneurial and then got out of corporate accounting. Wanted to bring that to the small business level and then analysis. It's kind of my gist of like starting the business. And so back in 2011, we have been around since then. I basically started with myself, and then now we're up to a team of 20 people. So I don't do all the work anymore, but focus on half of the house is accounting, half is tax. Within that, we have an advisory team, and so what we mainly look for is delivering not just transactional work, but being more proactive, looking into December 31st, making sure we're on track for deductions and tax planning, and just being a resource and being proactive with our clients on a weekly, monthly, quarterly basis, with forecasting, with um, operational questions and financial questions. And so that's mainly what we look for is where we can add value and be proactive.
You've not seen any of the clips that we're about to share, but is there anything that drives you nuts on the internet when you see people, see people say, or you're like, oh, that's so wrong, or do you try to stay off of TikTok and Instagram and the social media platforms?
Yeah, I'm not on TikTok, but I do see some of the videos on Instagram. The biggest thing for me is one, if they're not a licensed CPA, they're delivering this advice. Are they signing your return? Are they going to be legally liable when you take this strategy and file your taxes and take the penalty when you get audited potentially? I've seen a couple CPAs be, put out there like, oh, we're going to save you, $1 million. I mean, you know, it's all kind of in jest because it's based on like one client situation.
Hmm.
But not everybody's the same situation. Not your neighbor's not the same tax situation as you. So, just kind of take it with a grain of salt and know that it likely probably doesn't apply to you. It's just more of a sales tactic.
Yeah, no, I think that's valid, and you can also be a licensed CPA and say whatever you want, but it's not like they're going to be held liable if you take their advice on the internet, kind of deal. And so and I don't know your thoughts on that, but I think like anything across the board, anytime you hear it on the internet, doesn't mean like you should not take that as this is a blanket statement. It applies to me. My friends on one side that might say some things that are maybe in the gray, what they would say is they're trying to get people to think differently and go to their CPA and challenge their CPA to think differently. But on the flip side, you could be like, hey, like people are literally following these people and they're getting themselves into trouble because so there's arguments. I don't know if you have a take on would the world be a better place with no internet, no TikTok advice, or is it true like there feels like there can be an incentive for CPAs to not work for clients to help them save money? That's a frustration. Like most people feel like they're overpaying on taxes, whether they are or not, and they feel like their CPA or their tax team is doing the bare minimum. I don't know if you've experienced that where people have come to you, but I just, we're in this space and, very many people come in and it's a frustrating thing that they feel, maybe because they hate paying taxes, or maybe it's so complicated that it's hard to like feel like you're mastering it.
Yeah, I would agree with some of those sentiments. I mean, I attend these CPA conferences, and I can tell you that the majority of the people there are not at the top of the game, as far as like tax saving strategy. And for us, I mean, obviously we're outside the box. I mean, I have multiple businesses. I'm trying to maximize my taxes just as much as I am for my clients. And so we're more pushing the envelope, but avoiding a red flag when we put our name on a return. Whereas, most of the CPAs that I have come in contact with, they're just doing the bare minimum. They're just taking what you give them. They prepare the return, they send it out. They're not really pushing you. They don't really keep up with like how to get, kind of in the gray area. There's aggressive ones, there's very conservative, and there's a gray area. We play in the gray area. A lot of them that I come in contact with are very conservative. I mean, it's the nature of a CPA generally. And so clients are like, my CPA doesn't want to deduct a home office. I've had this like multiple times in the past couple of years. I mean, that seems a bit extreme, from a very conservative CPA when the tax code allows it. So when it comes to me, I'm like, that's kind of surprising and unfortunate. But it's like anything else. Financial advisors are the same. They're all over the place, and how they're going to advise you, and insurance agents, and so you
Yeah.
just kind of have to shop around and see who best fits, your needs the best and what would work for you better.
Love it. All right, we're gonna play the first clip. This is the media team has 7 clips for us to react to. First one is here's why IRAs suck. Would love your CPA's take on that.
IRAs suck. You can't touch your money till you're 59 and a half. It was a program designed by the government to make sure there's not a bunch of old, broke people running around. Anyone I know who has a lot of money or anyone who really understands money wishes they never got involved with it. And that's why.
What's your take
Selling
on that?
insurance, is that why he doesn't like IRAs?
No idea.
My take is, I mean, if you're under the age of 50, you should be maxing out a Roth IRA as much as possible. Backdoor Roths for individual, and then in your 401k plan, I mean, I would contribute to Roth. Uh, I mean, I'm in a high tax bracket. I contribute to Roth after tax because we're in a historically low tax rate environment right now. And it's projected that we will continue that way with what the House just passed. So I'm a proponent for IRAs, and at least maxing out as much as you can in the Roth annually to grow tax free. Because what people miss is that I always follow the old people, and when I go to conferences, I'm listening to the old ones, the 70, the 80-year-olds at the CPA conference, and they all wish they did more Roth. Because what happens when you get older and you start drawing Social Security and you hit RMD minimums with your pre-tax IRA, your tax bill goes up. And we're in an ultra low environment right now. Will that continue in whatever tax environment you're in when you hit 70 and a half? Who knows? I don't have that crystal ball either, but my guess is it's not going to be this low. So I'll take the free tax money on my earnings when I retire.
When you say free tax money, you're assuming with inflation, taxes potentially going up, that you're better paying the tax today, not having to worry about it, but then also like you're able to fit more money in to a Roth because you're paying the taxes out now, and so you're actually able to save more and invest more for the future. Is that is that do you agree with that statement?
Yeah, I mean, I manage my own portfolio, so the Roth money's growing tax free until I retire or turn 59 and a half. So that's what I mean by tax free money. But again, when I have Social Security income and I get to 70, do I need to take the Roth money? So if you have pre-tax money, you're required to take those RMDs no matter what. If it's in a Roth account, you're not, and that's where most people get hit with additional tax. In that older generation that I listened to in the 70s, 80s, because they
Yeah.
now realize they should have done it differently.
Yeah. So, question for you: when it comes to I'll talk to you about a backdoor Roth in a second. You can explain that. Is it legit? How does it work? But if Roths were off the table, would you still contribute to a IRA if you had to defer and postpone? So you're getting a deduction today, but you're not necessarily saving tax, and you could argue that you're paying more in tax depending on just inflation and all. What are your thoughts? What are your thoughts on that? Because it is a common strategy a lot of tax people use is contribute to retirement accounts, get that deduction. Their client is maybe happy today, but is it actually a tax savings long term?
If it's invested properly, it is, I believe. I mean, you can make 8 to 12% on your money. You can make that tax back in 3 to 5 years, and then it's growing tax free in a Roth account.
Well, no, we're not talking about Roths anymore. We're talking about if you don't do it through a Roth.
Oh, okay. Pre-tax
What,
IRA?
yeah, and a traditional IRA. What is your thoughts on traditional IRAs? And like they're sold as you get a tax savings, but I think that's not a correct statement. You're getting a deduction, but I think you can make the argument that
Yeah, you're
you're not
basically
necessarily
deferring the
getting tax.
tax
Yeah, deferring a
into the
tax to
future.
an unknown
Yeah.
date like you're deferring a tax to like. Do you believe the taxes are going to be higher or lower in the future?
Yeah, I mean, I agree yes and no to that statement. If it's only pre-tax and there's no Roth that exists, then I mean that's an argument for using your money in just a brokerage account to grow however you want it to be liquid. Um, yeah, I mean because you're basically deferring the tax until you get older. So what's the tax bracket going to be? So yeah, I mean I could be open to that argument on a pre-tax basis for
Okay.
traditional.
What is your okay? Explain to us how a backdoor Roth works, because someone could look at the basic Roth rules and say, I make too much money, I can't contribute to a Roth. And so, what is the way around that if that's someone that raises their hand?
Yeah, anybody can do a backdoor Roth annually, no matter how much income you make. What you do is basically contribute to a traditional IRA, and you don't take the tax deduction. And the backdoor is basically you rolling that traditional IRA money into a Roth account, and that is the backdoor way of getting money into a Roth account without having to qualify to put it straight into a Roth account. Backdoor doesn't seem to be going away. I didn't see it in the current tax bill, so I think it's going to be around a while.
And is there and any mistakes that people make? Obviously, you can't take the deduction. So is there any common mistakes that people that try to do it themselves make that disqualify them to do the backdoor Roth?
Um, Generally, no. I mean, what I generally recommend is make sure you do it like within the next couple days. So what I do, every January, I have it on my calendar to contribute to the traditional and backdoor it 2 days later to a Roth so that it immediately grows tax free. Because a lot of people will contribute to the traditional, wait 6 months, and then you have earnings that get rolled into a Roth that then are taxable on the earnings part of it. So you want to do it as soon as possible to do that backdoor piece.
Okay, great. Next clip is we'll get your reaction to this. It's got almost 10,000 likes.
If you want to go on vacation, you can make it a tax deduction now. So if my daughter wants to go to Disney, I'm going to make it a full tax write-off. And my CPA is totally cool with that. Because what you got to do is travel for at least half of your trip. But here's the fun part, is that one meeting for 1 hour for breakfast is a business day, right? So now I go to Florida and I'm gonna fly in, say, on a Thursday, and then when I land, I'm gonna make sure I go to a real estate meetup. Yeah, so those are fun. Go to Tampa, I'll be like, hey, I'm gonna meet some new friends. There's a meetup at 7 o'clock. I'll go there for a half hour. That becomes a business day. Great, right? That writes that off. Next day, I'm like, okay, I'm gonna go to have a brunch or something with a wholesaler in town. Great, day 2, business day. Saturday, Sunday, we're going to Disneyland, right? And then we sandwich it, and then the next day after that, I do maybe one more meeting. I've got 3 business days, 2 play days, the whole trip's written off.
What's your take on that?
He's not wrong technically. The trouble is if the IRS audits you, you need to prove, there was a legitimate business reason for you being there, and there was a legitimate reason for those meetings. You're not just showing up at a coffee shop for a meetup for some random strangers. So, I mean, that would be under a full audit. Like, what's the chances of you getting a full audit with that deduction in your return? I mean, that's the question. But
I think he potentially misspoke. He said like you have to travel half your days on your travel. Shouldn't he have said like you have to work? Technically, you have to work more than 50% to be able to write off for business? Is that actually how it works? If I travel for 7 days, to make that technically a business expense, do I need to prove that I'm working more than 50% of that travel?
I'm not sure about the 50%, but I have to look that one up. But I mean, I know, the travel day doesn't count. So now if you're doing a 7-day trip, you're down to 5 of those 5 days, which ones are, what are legitimate business you're doing. And that would be the deduction. Now, for a hotel, if you're there 7 nights, for example, but you're only doing business 5, you sometimes, or you're only doing business maybe 2 out of the 5 days that you mentioned fully, then there's a percentage of what you can deduct there. You can't just take the full 7 nights.
A lot of people on the internet are saying that you can just deduct the whole thing if it's technically if you're working more. So that's why I'm asking you, is that legit, or do you think that's a gray area that
It's a very gray area. Yeah.
what the other
Again,
thing that I think
if
is
you get
gray
audited,
is,
you're going to have to prove like that there's a legitimate business reason for being there. Like I
yeah,
can't just go to Disney World in Orlando and, have one business meeting on a Friday
yeah.
for the whole weekend and be like, oh, it was a business trip. I mean, if I got fully audited and that's all I could prove, I would be like, no, that's not deducted.
The other thing is just working 1 hour a day. I don't like. Isn't there a rule of like you have to like? Isn't there guidelines on how much you have to work technically? Like, and it just all comes down to documentation. Because here's the problem with entrepreneurs: we're very optimistic. I feel like I could probably write off anything because I'm always working in my head, but that's not how the IRS sees it. And so there's been like there will be times where I'll go to lunch or coffee and all, and I am working, but it's not, that doesn't mean that I can just deduct that. And so when it comes to travel, it's my understanding that you have to work more, like you have to justify that more than half that day is for business reasons. Now, maybe that's just a made up thing in my head, but that's my understanding of how it works.
Yeah. Again, I don't know. I would have to, I
Okay.
would look at I don't remember the 50%, but I mean, you could be right. I have to look
Okay.
that one up.
Well, the beautiful thing is people can fact check us with AI after the fact. So
But
you
there's
guys
a lot
can
of
do
tax court cases with, these deductions.
amazing.
And that's what the tax court goes off of. So again, it's a super gray area. You can get away with it. But if you do get audited, just know it can come back on you. So
What's the worst case scenario when you get audited? Let's say you do this trip and it's like you're working for 3 hours, you write the whole thing off, you get audited. What's happens when this person loses the audit?
I mean, that deduction comes back, your income goes up, you might owe more taxes, penalties and interest on the tax owed. That could be the difference there.
So what would you say to someone that says it's worth the risk? I'm gonna have to pay penalties, potentially, probably not if it's my first offense. I'm gonna have to pay interest, which is valid, but the likelihood of me getting audited is low. What is your? I mean, again, this is all. I'm just trying
Yeah,
to
I
be
mean,
devil's advocate with you. What
like
is your?
we're not an ultra high risk firm. We're not willing to risk a red flag. So for us, we're not willing to put our name on that return, because if you do get audited, the first thing you're going to do is point the finger at us like it was our fault, and we don't want to be liable for it. So as a CPA, so in that case, we'd tell you to file your own taxes because we know legitimately we couldn't defend it. That's our biggest thing. Can we defend it if we put it on paper? And something like in that example, no, we can't defend it to the IRS, so we're not going to
Okay.
risk it and
When
put our
someone
name
goes
on
on
it.
a business trip, what do you want them to do to be able to write off the whole trip?
Um, I mean, there needs to be some legitimate business meetings. I mean, we at least needed an email, some documentation, like what you did,
Okay.
and who you met with or something. And then, is it reasonable? You're not flying, your whole team like private jet
Yeah.
and staying in, Four Seasons like for a whole week just to hang out and have spa treatments.
Yeah.
There's got to be like legitimate reasons for it, but
Yeah, I think that one of the
reasonable.
biggest thing is can you justify this? And I think another framework to think about is if you're not the owner and justifying it to the owner of the company, how do you make them feel good that this is a write-off? And I think, again, like, this is not, I mean, I'm not the CPA here. I'm just like, how would I just, like, if I were spending someone else's money and it was a business write-off, would the owner of the company be excited about that? And, or be like, oh yeah, that's absolutely. And if the answer is no, that usually means that you're probably using it as a loophole for yourself. But if the answer is yes, that probably means you have some type of way to justify it if you do get audited. So that's okay. Next one, we're gonna realize why all the rich people drive G-Wagons. Here we go.
Why do all rich people drive G-Wagons? This is top secret info. I promise to tell you if you keep it between me and you. Alright, so why G-Wagon? Under tax section 179, you can write off any vehicle over 6,000 pounds and use for business. Let me guess, G-Wagons are over 6,000 pounds, and if you buy it under your business, you can write it off and pay less taxes. Yep, that's correct. You get to write the entire thing off. Yeah, you definitely followed the Remelanin King.
You know, my favorite thing about that is after the pandemic, most people work remotely from home now. And so what we generally get is like, yeah, I'm going to buy the G-Wagon and I get 100% deduction because it's for business. I'm like, well, where do you drive?
Yeah.
They're like, well, I don't really drive. You know, I might go to the bank or something. But I'm like, well, how are you going to prove the IRS is 100% write-off? So most misconception is, you know, you have to, if you ever get fully audited, it's clear in the IRS code, you have to provide a mileage log. So we recommend like Mileage IQ for business miles on your phone, but you know that's the first thing they're going to ask for to provide it. So if you're working from home, how are you going to provide, you know, 10, 15, 25,000 miles a year driven as 100% business deduction?
Yep. What would your recommendation be, hypothetically, if I was to get a G-Wagon and want to be able to write some of it off, but let's be honest, some of it's going to be for business, some of it's going to be for personal. Would you recommend, like, how would I be able to potentially take advantage of the write the whole thing off, or would I not be able to if I was going to do a little bit personal? Because most people,
Yeah, you can take a percentage. I mean, we
okay,
take percentages for sure. I mean, is it 10%? Is it 90%? You know, somewhere
and
in
is
in
you just, are
between.
you guessing because you're technically, like, you're taking it in year one, but you don't even fully know. So is it just a good faith guess?
Well, I mean, you have miles. So if you had 10,000 miles in the year that you own, you know, the first year you owned it, tax year, and you drove 5,000 of those for business, then the 50% is the deduction.
But okay, so then if we were going to go that route, would you recommend depreciating the whole deal, or just like when
Well,
you,
you'd only get 50% depreciation
right, but
or write off.
when would you recommend not doing the depreciation route and just doing the mileage route?
Well, I mean, that's kind of different from the video here, but you know, it really depends on the personal level. I mean, I tell clients if you drive a lot for work and business, then and you like to keep your cars longer, like I keep my car till it dies. I'm not a car guy, so you know, if that's the case, then you're better off taking mileage because it's lucrative at 67 cents, I think it is this year per mile if you're driving that much. If you like to trade in your cars every 2, 3, 4 years, and you want something new all the time, you don't drive a lot, then you know depreciation may make sense. But no, once you take depreciation, you can't go back. It's just depreciation and actual expenses, gas, you know, oil changes, tires, maintenance. You don't get mileage. You can't ever flip flop. So you know that's kind of the thing you have to think about once you have a new car, and what we like to discuss with clients and what their longer term plan is for it.
I think a common mistake is that, I mean, I guess I'll say this: if you have a super expensive car, it probably makes more sense to depreciate a percentage. And if you're buying a super old, let's say G-Wagon or kind of deal, that's a $10,000 G-Wagon, you may find that it's better to take the mileage. I think it's based on the situation. What I believe that most people are getting wrong with TikToks and all is they're assuming everything's for business, and that's what most people are actually doing. Chase,
Yeah, I know.
and what you're saying is if they get audited, it's just not going to hold water and most likely they're going to be able to write off a percentage. But what happens if you get audited and the IRS asks for your logs and you just have never? I mean, most people don't have logs of their personal
Yeah.
and business. Does the IRS just disallow the whole thing?
Most of the time, yeah. I mean, if you read the tax court cases, they'll say provide it to us. If they'll know if it's made up. Generally, there's a lot of court cases that show like people that submitted documentation and they messed up, like they recorded mileage, you know, in two different places on the same day or something. And so if you try to backtrack that far, they generally will know better. But yeah, but that's what the IRS requires is mileage log. Who keeps up with it? Probably no one. But I mean, I don't keep up with the mileage log, but I know on a percentage basis, like based off Google Maps and driving, what I spend annually.
And this is, I mean, we're gonna get into the next clip with the Augusta Rule, but this is where you can feel like, and I'm not saying that this is the right thing. I'm just saying this is what some people are thinking, including myself. It can feel overwhelming to be like, okay, technically everybody's not compliant. I mean, you technically have to be like really, really rich to like check every single box. And I'll give you the benefit out. Maybe all your clients are super compliant, but does the IRS like, do they at least, can they read, like, can they like give you the benefit of the doubt, or can they say like, you're doing this in good faith? Like, yes, like you wrote off 40% of your car. Here's the general reason why, but Caleb, you don't have the logs. We're gonna be good. Or they're like, hey, you don't have proof. It's you're hauling your butt.
Yeah, it really depends on the agent that is auditing you. But I would say in general, like if you're buying a G-Wagon and 100% deduction, that's going to be a red flag,
Right.
in the system.
I guess
What
does
does
the
that cost?
IRS have to prove?
$120,000, on a vehicle, 100% deduction, and depending on how much your business made, what is the percentage of that? A lot of people don't realize the IRS has a lot of AI tools that,
Yep.
they're tracking the numbers and percentages based off your type of business, your revenues, your expenses, and they have all these different tools and analytical metrics that they use to kind of pull out the red flags. And
Yep.
something like that, like if you're making 100 grand and you deducted $120,000 G-Wagon, that's probably going to be a red flag for you
Yeah.
in
You
general.
might get audited a little bit more frequently than the person not doing that.
Yeah, but if you made
Yeah.
$1 million and you
Yeah.
deducted, I mean, you might get away with it. I don't
Yeah.
know.
Okay. Okay. Again,
But
none of this is tax advice. I don't. It's not every day that I get to talk to a licensed CPA that has a practice, does this day in and day out. So it's just really helpful. Let's go on to the next clip on the Augusta
It's
Rule.
called the Augusta Rule. So you can, if you own a home, or if you own a home, it's not for renting. If you own, you can rent out your house to your business, right? So you rent out your home to your business as long as you're doing business activity in the house those days. So if I have a business, I can rent out my home to my business, pay myself, let's say a reasonable rate of $500 a day for renting a house out. You create a lease agreement leasing out your primary residence to your business, charge your business $500 a day. You're able to get that money from your business, and all this is tax free.
Wow.
yeah, that's accurate.
What's the biggest mistakes that people make when it comes to the Augusta Rule?
The biggest one is, they just think they can just take 14 days. Just in general. I mean, you got to have a business reason for it, as he stated there. He was correct. Did you have an event? Did you have employees over or vendors or customers over or something? And then a lot of people, assume they can treat their like home gym or their home pool as like a business deduction. It's kind of an ancillary of that Augusta Rule, and they treat it as employee benefit. But we've had clients where their home was like in Austin, where we're at, and their employees are all over the country. So we're like, your employees are visiting the gym and the pool on a regular basis. Like that's not legit. Like flying through the IRS radar. So it's all depends on the situation. But when it comes to the money, you mentioned $500. We generally, when we're taking it for clients, we generally will go on Airbnb
Hmm.
or something, a platform, and look at like what the houses are renting for in the area to make sure we have the right
Yep.
number.
That's key. I think the common misconception is like it's you have to be able to back up what you're charging, and you can't just be like, oh, my house is worth 20 grand a day. It's like, okay, back that up, you know? And it's like, would someone out? It's again, it goes back to the theory. If you were renting this house and you didn't have any financial benefit to it, could you justify that as a good benefit to the business? And if the answer is no, then good luck. And so that's a problem. And then does this work if someone just has like a LLC pass through, or do you need to have some type of corporation like S corp or C corp to technically do the Augusta rule?
We haven't seen it as much on Schedule Cs. It really depends on the business and what you're doing. I mean, if, most of the time when you're a Schedule C, you're kind of just a contractor working at home. So like what business would you be doing other than like, are you inviting people over, like your customers? Generally, you're working with one or two customers that are bigger, so you're not going to invite people. So, again, you got to have a legitimate reason. But yeah, I mean, normally when you're a S corp, C corp, or something partnership, you've got kind of a larger business usually, and there's more to it that could potentially be a reason to rent out your house for the day.
Okay. Okay. So even if someone has it's more, it just has to be reasonable, and if it's reasonable, you could back that up.
Yeah, defendable. Back to,
Defendable.
the word defendable. Like, can you defend it in an IRS audit? That's what we look for.
Got it. Okay. Next clip is how the wealthy legally pay zero in tax. This will hold on. Next, let's do how the wealthy
I
legally
mean,
pay.
we all want to pay zero.
Yeah. Yes. This sets the bar high. Are you ready?
Dad, so you make $10 million a year. That means you pay about $3.3 million in taxes every year. Do I look like I have stupid written across my head? I pay zero taxes. How? First, I don't spend my money personally. I let my business pay for things legally. Travel, business expense. Meals, business expense. Even my luxury car, a tax-deductible business asset. That means before the government takes a penny, I'm reducing my taxable income. Second, instead of taking paychecks like a regular employee, I leverage business assets for loans because loans aren't taxed. And third, instead of selling investments, you use them as collateral and take loans. Again, loans are not taxed.
Wait, so wealthy people just keep recycling their money and avoid taxes legally?
Exactly, and it's not some mystery or secret. Everyone can learn this.
Where did you learn this?
I follow Andre Pennington on social media.
All right. So just for context, that has over 438,000 likes, 48,000 shares, and over 121,000 saves. So it's an understatement to say that this clip has been seen by lots of people. What are your takes on his three things that he talked about?
Yeah, a lot of generalization there. Again, your taxes aren't the same as your neighbor. So, business, I mean, we kind of talked about the travel and the meals earlier, so in the cars. So, yes and no, depends on your situation. Now, the difference is number two there, the assets, because what he doesn't really mention is he's probably a real estate investor, and he's getting, a cost segregation deduction on what he's purchasing, and that's how, you're lowering your current tax bill through what you're paying. And so from those investments in getting that cost seg, he's probably investing, the profits from it. And then, I mean, anybody can borrow against their portfolio with their brokerage account. So that's pretty standard. But I would say the biggest one's number two, and that's where he's, they're kind of skirting the details and generalizing why he doesn't pay taxes. But my guess is he's a real estate investor taking those big deductions, just like every other real estate investor does. Now, a lot of people, to that point, a lot of people don't even know what a cost segregation is when we talk to them and they've bought property. Cost segregation allows you to front load depreciation. So, for example, if you buy a rental property or you buy a commercial property, it's 30-year straight line depreciation. In order to get more, you have to cost segregation that through a legitimate company. You can't just do it yourself. And that basically front loads depreciation for the first 5 to 10 years. So what they take is the roof and the walls and the electrical and the pipes, and all of those things have depreciable lives. and they're fast tracking it up front. So you're going to get it up front, and generally how you have to keep that wheel moving is you keep having to invest in other properties, because if
Yeah.
you just do it one time, after 5 years, you're going to have a huge capital, you're going to have a huge profit because you have no depreciation against your money that you're making.
Yeah.
So you got to keep reinvesting in more property to keep the deduction going to not have the profits in the current year.
And then if you sell it, the deduction, don't you have to pay that back?
Well, I mean, and then again, as a real estate investor, if he's reinvesting, so he's selling it and he's 1031 exchanging it into another property and deferring those capital gains down the line. So that's where he kind of probably gets into leverage, where he's rolling over that investment he just sold into another qualified 1031 exchange.
And then the goal is to just die, and then your kids get
Yeah, and then you can get loans against those assets externally, personally for it. You can put it up as collateral sometimes. There's 1031 rules around some of that, but that's what his number three is there. He's leveraging to get cash out of it.
Do a lot of your clients lend against their assets? And if so, what are the pros
We
and
don't have a
cons?
lot doing the lending part of it, but definitely the cost seg and the 1031 exchange we do.
Okay. Yeah, it's interesting because obviously people look at like Elon Musk and he's able to, or Jeff Bezos, and it's it's easy
Yeah,
to.
these are my favorite examples because these people have worldwide resources. Okay,
Yeah.
you can if you have if you have 8, 9 plus figures in your account, in your wealth, then yeah, you can go around the world and start skirting some tax issues. But if you're making, under 10 million or 100,000 a year, you're not in that same school as those people. So
and this is a hot take but it's some people try to overcomplicate things, and I would say borrowing against your assets is probably not a great strategy.
well, I
for
mean,
most
some people are
because it
comfortable
feels
with high
risky.
leverage.
Yeah,
I don't want to be highly leveraged to the gills,
me neither.
and risk, all of it, because, that real estate portfolio, something could happen to it.
Yeah.
And, if you're leveraging against it, it could go south quickly. But a lot of people like to take that risk. I like to be in the middle.
Okay. Um, the middle doesn't make good content, just so you know. We gotta be extreme.
That's why I'm a CPA,
That's right.
It's just my nature.
I love it. All right. Next video is here's how to legally avoid property tax. Love your take on this one.
You can legally avoid property tax. When you buy your home, you don't actually own it. You see, the government can take it away if you stop paying rent, and then they'll auction it off to the highest bidder. But if you want to avoid that, you need to bury your relative on your property. This is exactly what Donald Trump did with his golf course and what Elvis's family did with Graceland. If you put your home in a trust and it's a cemetery, nothing can ever take it away. Not the bank, the government, lawsuit, or bankruptcy. Your house is completely protected. If you want to protect your home, then go ahead and comment the word trust, and I'll show you exactly how it's done.
That's interesting. I've never heard that before, where you bury somebody. But I mean, how many people have enough land where you're going to bury somebody on it?
There's another clip that I reacted to a while ago. There's this lady that was like, guys, I have this best kept secret. Like, if you bury someone in the backyard, your house is a cemetery and all. And when you fact check it, it's just not accurate. It's very regulated. And then if you bury someone, you can technically, like, that plot of land.
I was going to say it has to be.
It doesn't necessarily
parceled out with
Yeah.
this county, right? If you're going to have a cemetery.
Oh yeah, I mean, trust me. Like, let's not go bury bodies on your like, there could be bigger issues with that. But the other thing is, it doesn't
Especially
necessarily
in a
make
neighborhood.
it doesn't even make your home a cemetery if you're using it. It's almost like the IRS, whether you like them or not, like, they're not dumb. And it's like, it's like, you really think that's going to fly? And so my thought process around the trust, I think, could be an interesting deal. So I don't know if you have any comments on, like, people using trust and avoiding property taxes. I will say this is not financial advice.
I've
I
never
do
heard
believe
that
that private family foundations, or if charities own property, that there's in some counties, they don't have to pay property tax. And as a
Well, sure, because
result,
it's a charity.
it's a
But
charity. So there have been people that I've known that their home is not owned by them. It's maybe controlled by their charity or nonprofit. Again, not financial advice. You obviously have to make sure that it's set up properly. And at the end of the day, the benefit needs to benefit not you or
charity.
your family. It needs to benefit
Yeah.
the charity or the nonprofits. And so
Well, that's the thing. I mean, the IRS is going to want to know where your primary residence is. If it's the charity,
yeah.
then why aren't you paying? I mean, well, the county at least would want to know why you're not paying tax on it.
But I don't even know with certain trust. It's hard for me to imagine that even if like an irrevocable trust owned property or land, wouldn't you still have to pay?
Yeah, not a general trust. I mean, we're talking about a charity here, like a
No, I know.
501c3.
But, a charity or nonprofit, I think that's in some cases you're good. But in an irrevocable trust, we're not talking charity, we're talking trust. You'd still have to pay property taxes, I would imagine,
Yes.
in that setup.
Yeah.
So
And then, in general, back to the parcel of land, I mean, the same, the IRS still looks at what the primary residence is, like where you live day to day, what you claim on your driver's license, where you get mail from, that's your primary residence. And then the county, you would need to parcel that primary residence out. You would still owe property taxes on that piece. And then, if people have land, that's why they parcel it, because the other acreages are farmland, to pay a lot less tax on it. Same scenario with the cemetery.
yeah, not financial advice, but burying your loved ones on your properties probably there's better ways, because it's not free, I would imagine, and I just, don't ask me how I know these things, but I've heard, let's just say that because we've been looking at different real estate, and there's been some properties that we've looked at. There's cemeteries, and they're just like, don't even ask. You can't move. It will literally, like, impossible to move these things. And so,
you can't.
So it's just one of those things, heavily regulated. Lots of people need to, approve it, and it's definitely not free. So not financial advice, but find a better tax strategy if that's where you're going. But thank you for making that video to give us content.
I love these random videos you found.
Yeah, well, no, shout out to the team. All right, next one.
Most people don't know that if you own land and that land isn't improved upon, you don't have to pay property taxes. Meaning, if you don't have a crane parked on a development, you own it, but the ownership is passive in the sense that you don't have to pay any property tax. It is a loophole.
How in the world is that? Is that straight up a lie?
I mean, talk to your county on that one. Maybe some do, some don't. But I know I'm here in Texas, and they don't give you free property taxes unless you have an exemption, filed with the county to not pay. But there would have to be an exemption reason.
Okay.
If you just own land, you owe some property taxes. I mean, yeah, it's unencumbered. There's no improvements. Then yeah, you pay a lot less. Like maybe here in Texas, maybe it's $1,000 on 10 or 20 acres, but versus 5 or 10,000 with a house on it. But that's just one example.
And there's no difference of personal property versus business property, because that just doesn't make any sense to me.
No.
Like, obviously the property tax is going to be based on the perceived value.
County doesn't care who owns it.
Yeah.
They just want their taxes.
That's right. Okay. Well, very, very, very interesting stuff. But we're out of clips. I wish we had more. This has been a lot of fun.
I like this.
And as we wrap this up, there's obviously, again, the common person we're talking to is creating value. They're making money. They do not want to pay any extra money to the government that they have to. And I believe that, just my personal opinion, that people and the economy would be better off having them spend the money than maybe the government spending on what they're doing. Personal opinion. But it doesn't matter what I think or my personal opinions. You still want to do the right thing. And so any final words when it comes to whether people work directly with you or somebody else, what type of things, what type of frameworks, what type of questions that they should be asking to try to save them as much money as possible?
I mean, we're obviously looking at anything we can, save money on. I mean, I do too. Again, I own multiple businesses, so I want to save as much as possible. For me personally, I mean, I like to sleep well at night. So, I don't, again, want to raise a red flag or risk an audit. I don't want to have to be looking over my shoulder thinking one of these days is going to catch up with me in one of these returns. So, yeah, I like to pay no tax, and I hate writing the check when I have to write it on the income I make. But at the end of the day, um, it's a cost of doing business. I would say, I love travel. My family is from Europe. You know, comparing what we pay versus what they pay is significantly, I repeat, significantly less taxes than, what Europe is paying, and in particular Germany, where my family's from. So, on the grand scheme of things, it's a cost of doing business in America and building wealth here.
Yeah, and here's my final take is most people just spend too much. Like they get themselves in trouble because they overconsume. And I do, we kind of goes back to the leverage aspect is leverage is an amplifier. Like straight up, leverage can be amazing. Leverage can actually reduce your risk if you do it properly. Most people that get themselves in trouble with leverage is just amplifying consumption. And anytime you try to amplify consumption, it's you're just increasing, in my opinion, personal risk. And when it comes to tax strategies and all, like, yeah, you might be able to save some money, but you may have some tax strategy that hangs over your head that potentially creates liabilities in the future. And so my thought process is do whatever you can, but make sure that you can sleep well at night. And if you don't understand it and your CPA is not willing to like sign off on it and defend it, then maybe think twice about doing certain things. But Chase,
Yeah,
it's been
how much time do we have here?
we got time. Yeah.
I got a perfect example to that statement. Years ago, financial advisor, we were referring to our clients. They were putting them in these easements, and we read through the documents, and me and my tax manager were like, no, you can't get a 3 or 5x deduction on what you put in year one and be legitimate. Like it's just not possible. So fast forward. The IRS is now auditing all these easements. The clients are now involved in the audits. They're having to give testimony to the tax court. It's a sense of worry, and they're having this hanging over their head because they don't know what the ending outcome is. These easements promised insurance on these deals, and that's not covering it. So they got the deduction. They were like, yeah, it's legitimate. It's we got it. Okay, whatever. We told them it was not legit. So fast forward, now they're being audited. Is it worth that much in your life, to have that deduction? There's other more legitimate deductions. Like I did oil and gas lease last year. It's active business. You can get 80% deduction. I'm not going to get 3 to 5x what I put into that, first year as a deduction. That's just not legit. I might get 100%, but I'm not going to get 3 or 5x in the first year. Like, just think, like, does it sound reasonable at the end of the day? And are you willing to have that, over your head for years to come in tax court? Are you willing to, deal with that? Some people are, some people aren't. I'm not, and my clients certainly aren't either, because they've been telling us every year about it, and it's still going on 5 years later in tax court, and it's just like never ending for them.
Yeah. There's a peace of mind that is potentially worth paying a tax for. So, Chase, appreciate you a ton. Thank you so much for coming on the show, and excited to see what the comments are, and we'll see all the AI experts as they're able to in real time fact check us and give their thought process. We want to hear your comments. I read them all, and you always make us better. Thank you so much for subscribing. We'll got links down below. We'll give links to Chase and what he's up to, and so anything that you want to plug, Chase, let us know. And wish you the absolute best, man.
Yeah, thanks again for having me, and feel free to hit us up at insomniacpa.com, INSOGNACPA.com, and love to talk to you if you need our help.